Today, the Federal Reserve announced the start of a new round of stress tests for U.S. banks, and the question we're all asking ourselves this Thanksgiving week is, why should we care? So, as a recap, the way these tests work is that the banks are going to submit to the Fed their plans for what they're going to do with their capital next week, and they're also going to test their balance sheets for how they would perform under various economic scenarios, and we're going to go through some of those. So, Tom, you're the U.S. banking editor, so presumably you have some vague idea of what's going on here. What can we expect to learn from these tests?
Well, we can apparently expect to learn whether the likes of Morgan Stanley, Bank of America and their friends can weather a worsening economic picture, not just in the US, but also in Europe. And I think that's quite an important element of this year's tests. I mean, obviously, one of the biggest overhangs of US bank stocks is worries that they're going to be dragged into some morass started in the Eurozone. And this should give us a better idea next year of how their balance sheets measure up to that.
So when it comes to the Eurozone, though, the test specified a certain scenario over there, and it said that if Eurozone GDP goes down by a certain amount, then the banks have to tell us exactly how their balance sheet would be. Mm-hmm. That's not really what everybody's worried about, right? We're not worried about a recession in Europe. What we're worried about is the U.S. banking system's exposure to the European banking system.
Yeah, that's right. And I mean, the banks will have to plot how they will cope if, you know, a big counterparty, say ex-French bank, goes bust. So that will be in the planning as well. And that's for the six biggest. So some of the smaller banks don't have to do that modeling, but right. the global market shock scenario is for the likes of Goldman, Morgan Stanley, Citi, etc.
Sure. So one of the things you were worried about in the column you wrote about this before the tests were announced was that these tests in the past, last year's, the prior years, weren't as transparent as they could be. We were sort of left to figure out exactly what the results were for specific banks, right? So yeah. It seems like in this case, the Fed is starting to address that concern.
Yeah, that's right. Actually, 2009, which was the first one, was pretty transparent, and that proved to be, you know, some people were skeptical then that the test would be rigorous enough, but actually it was a good confidence boost to the market, and they were fairly transparent last year, and I think possibly because we thought the world was getting better, there was less transparency at the back end. And they are going to address this year, and I think that's going to be very interesting. In March, we're going to see how, you know, the B of A would fare, for example, in this stress scenario, which includes US unemployment at 13% and a 7% or so decline in real GDP growth in the Eurozone. So I think we'll see revenue, we'll see capital against those barometers.
I think the banks that we're all worried about are the too big to fail ones. And you mentioned Bank of America earlier. That's the one we should all be watching out for come March when these results come out, right?
Yeah, I think so. And as news of the stress tests were announced after the market closed just a few minutes ago, there was a sell-off in futures, and there was some speculation this could be because on fears that banks will actually have to raise capital, never mind not increase their payout to investors. Could we be back to a situation where banks are raising capital? They have to prove that they can have over 5% core tier 1 capital against the stress scenario, for either for B of A or for other banks. You know, I think the market expectation generally is that they will be there, but it's going to be closer for some than others.
Any chance that some of these banks are going to be asked to start shedding risk-weighted assets in order to make those capital ratios?
Well, yeah, I mean, I think that is happening naturally, and, you know, B of A, not to hound them, but they are a specific case. They are shedding assets, and went indeed from the biggest bank by assets to the second biggest after JP Morgan as part of that process. I think, you know, the real capital hawks out there would actually prefer people are forced to raise capital rather than shrink the size of their balance sheet.
Right.
And, you know, that is held in reserve as a, you know, emergency tool if required.
The banks just got wind of exactly what's expected of them, what happens next, and when are we going to finally find out exactly, you know, what it is that they need to do.
Yes, they've now got to the start of January to model all these stress scenarios, work out if they want to increase their dividend payout, and, you know, package that up and send it off to the Fed, who will then spend until March examining it, and, as I say, publish some of the results, then.
Well, I'm sure they're thrilled about this holiday gift from regulators then. And you can follow developments of this story on FT.com, where you'll find Tom's story about the announcement and his column from earlier this morning. Thanks.